Today, what have the big beasts in the mortgage industry to fear? Hello, I'm Martin North from Digital Finance Analytics. Welcome to my latest post. Today, we're looking at the mortgage industry in detail and also thinking about some of the issues relating to potential class actions. And I'm joined by Roger Brown. Roger, hello.
Hello, Martin. Pleased to meet you.
Great to be here, and thanks very much for spending time with us on this channel and with DFA. I think a great place to start the conversation would be just a little about who you are and what your background is.
Right. Well, my career was in insurance broking, placing covers at Lloyd's of London, underwriters, and I specialised in civil engineering and mining risks in various parts of the world, in particular Australia. So that includes underground mines, above ground, open cut coal mines, power stations, offshore oil rigs, you name it, the ones which had huge problems when things went awry. That was my specialty. The Snowy Mountain scheme in Australia, I was very much involved in particular the Talbingo Dam, which at that time in 1967-68 was the largest dam constructed in the world. So that was a major insurance project. Mm-hmm. And I continued that up until recently, 10 or 15 years ago. And during that last period of time, I was a consultant to certain law firms in insurance law as a flow-on from that part of my career.
Okay. And you've got a particular interest now in the whole mortgage sector. So how did that come about?
I sure do. Yeah. Well, mainly because I became interested in the fact that about 20 years ago, the market was showing signs of irrationality in terms of price increases, where you would be talking to someone who said, you know, I bought a house for $160,000 in 1999 and my family said I was crazy. And yet 3 years later, I doubled my value, doubled the price. And I thought to myself, well, being from the generation who bought houses in the 60s, where prices went up 2% per annum if you were lucky, and given the history of 100 years statistics in residential home prices, both here and the UK, Canada, New Zealand, you average about 3% per annum, taking any decade at a time. So here we were moving into the 2000 year with price increases of 15%, mortgage brokers coming on the scene saying this is normal, in fact it'll get better. And so it did. It kept increasing. And I just came to the view that this had to blow up somewhere along the line. I was also aware of the fact that banks no longer had a face-to-face involvement with buyers of homes and seekers of finance, and they used intermediaries to do that, being called mortgage brokers. Now that meant, as far as I'm concerned, that information could be misleading. The broker is in fact the agent of the bank. I've always said that. There is legal precedent that shows that. And I thought this would blow up by reason of the fact that people would be able to borrow too much, house prices would be escalating continuously, and more to the point, they had the time bomb of interest-only loans and no principal repayments, which I couldn't, for the life of me, believe was allowed by the regulators, APRA in the main. Mm. So I started predicting Armageddon. In fact, around 2006, I started talking about it, and the usual things happened. I remember Steve Keen, that I know very well. He was talking about how the crash was going to occur, and he said, if it doesn't occur, I'll walk to Kosciuszko and back, something like that. And of course, poor Steve was left with a long walk. So it was a question Martin, of the timing. Then you had the GFC in America, or the subprime crisis, I should say. And in fact, it wasn't a global financial crisis, in my view. It was a mortgage crisis. And so that started to show what can happen when you get corruption of a system of borrowing money. And I simply have waited for the outcome in Australia, which, in my view, started about 2 years ago.
Yeah, indeed. And of course, I interviewed Steve Keen a couple of weeks ago, and his comment was, "I was right, I just got the timing wrong."
Yeah, that's right. And he's now a little too old to get to Cosiostrum
well,
back.
that may also be true, I'm not sure. But it's interesting, isn't it? Because essentially we've seen significant run-up of home prices and debt, and we've got some of the highest debt ratios in the world. And of course, the Royal Commission has really cast a spotlight on this over the last few months, particularly in terms of very poor lending standards and practices, and the fact that many people have ended up with loans they probably should never have got in the first place. And we're now seeing also the other consequences, which now as lenders begin to tighten, essentially we're finding people now cannot do anything with the loan they've got. So they've got this nasty surprise, which is a loan that they can't refinance, and it's extremely expensive.
Yeah. Well, that's the point, that mortgages in the old days were for 25, 30 years, as is the case still in America. So that tells you, if you've got a fixed rate, that things can't get out of control. You don't have to renegotiate a loan. And what they've been doing of the last 2 decades is short-term financing, effectively, of 3 and 5 years, which is backed by wholesale funds from overseas. And as you know, Martin, there's a century-old adage that you never borrow short to invest long. Now, the banks have, in fact, decided to take on that theory. But the ultimate price will be paid by those who are contracted under a mortgage, where if at the end of the 5 years the banks say, no, look, we don't want to renew or roll over this loan because A, the prices of houses have gone down, or we just don't want to do it, these people are up the proverbial creek without a paddle. And no one has been anticipating this except for the likes of yourself, Steve Keen, and a few others. Certainly the regulators have never given any semblance of warnings to borrowers, let alone impose some conditions on the banks, until 18 months ago when they said this interest-only lending has to cease, or not cease, but be cut back.
Yeah, so they've really, I mean, my perspective, as you know, is they're late to the party, and they've, to an extent, missed the boat. And in fact, there was a speech from the Reserve Bank earlier in the week when Michelle Bullock was talking about household debt and was saying, well, household debt is very, very high, but actually it's sustainable. There's nothing to worry about. I have to say that my perspective on what's happening is somewhat different to what she's representing at the moment.
Yeah, and given that the wholesale funding is something like, I think, 30 or 35% of the bank's books, they've got no guarantee that that money is going to be flowing back in or even staying here over the next decade, over the next 18 months. What happens then?
Yeah, and of course, a lot of that overseas funding is actually short-term funding, under 1 year. A lot of it's on 90-day. So effectively, they've got this revolving issue even now, and as interest rates in the US go up and therefore the capital market rates go up, that's an immediate continued set of pressures on the banks in terms of their funding, which is one reason why 3 of the 4 have moved on the rates. So I mean, I think we can all both agree that there are significant issues. But of course, you're taking that conversation a little bit further insofar that you're beginning to corral activity around a potential class action. So can we talk a little bit about that now?
Yes. Well, I took the view that when the train ran into the buffers, as it had to and has to, then there will be aggrieved parties who are financially stricken and will need or will seek recompense in one form or another. And that's when you look around to see who is carrying the can, who's responsible for this. It certainly isn't the borrowers. I know that everyone likes to say, well, the borrowers went into this with open eyes and they knew what they were doing. I'm not so sure about that because, as you'd know, Martin, in the UK, the FCA, or previously the FSA, made it mandatory for all lending institutions to have on the bottom of their advertisements the most incredible statement. It sounds very nonsensical, but it basically said, warning, if you fail to pay your interest on any 1 month, you may lose your home, which is akin to saying if you fail to breathe in the morning, you may die. But,
good analogy.
But they said it by law, which means they were serious about imparting some warnings to consumers. Not so in Australia. Not so in Australia. And so the end result is that the law comes into play to see who's responsible for what. And it happened in America, 07, 08, the consequences of that. It wouldn't matter whether it was Fannie Mae, Freddie Mac, or Lehman Brothers, whatever. Class actions from shareholders, you name it. Class actions from those who purchased bonds that were on the back of these dodgy loans. And the same, I have maintained, will occur here. Now, the Royal Commission's been helpful in as much as it has shown up the weaknesses in the system, the corruption, the fraudulent activity by certain bodies. And so I started looking around 6 years ago to see what might happen here. Most people were sceptical about there being any likelihood of legal avenues when this should happen. That's not my findings, and I've certainly spoken to many lawyers, lots of research. We've done joint research. We believe that both the banks and the regulators will be brought to account, hence these class actions.
And it's interesting that you are identifying separately the regulators and their roles, as well as the lenders and their roles. And essentially, yes, it's almost like two different perspectives on the same conundrum.
Yes, because they are entirely different. One is to do with mandated responsibilities. The other is to do with its modus operandi of operations and how they go about selling their product and making their profits.
Yeah, indeed. No,
there's a clear distinction.
Yeah, indeed. And of course, the regulators are conveniently carved out from the current Royal Commission analysis.
Yeah.
Although,
are you wondering why?
Yeah. Although I was going to say you got enough from the sort of the sideways looks that we're getting into it to realise that there actually are a bunch of issues on the regulatory side as well.
Yes. Yeah. Yes, exactly.
And I know that there are some sensitivities in terms of the process you're going through and how you're shaping it. So I don't want to tread on ground that we mustn't talk about. But can you give me a little bit of indication of where you are in that process of beginning to corral the efforts towards a class action?
Yes, we've got thousands of documents that have come, some off the back of trucks, some from inside, others pure research, others legal opinion, that indicate that there's a strong chance of success in these areas of class actions in some form or another. The funding I'm finalising in November in London. When that point is reached, we will be able then to get the final council opinions in Australia on these the claims that we have as causes of action, and then it will move forward. It's not going to be one of those pre-advertised matters where and I don't want to raise the matter of the AMP shareholders class action, but as you would know, it's become a dog's dinner in the end. So that's how we're going about it.
Okay, so you're laying the foundations a little bit below the waterline, as it were, until you're ready to
absolutely
move forward. Yeah. Okay.
Yeah. Not firing any shots and not even disclosing what the ammunition is and where it is.
Sure, which is
absolutely.
Yeah. Okay. No, fair enough. But nevertheless, your perspective is that there is a significant set of issues here, which has significant legal merit, and if you look at the way that this could play out, clearly there could be significant impost and impact on the major lenders, as well as indeed the governments and the regulators.
Yes, yeah, exactly. And only 2 days ago, Slater and Gordon announced the launching of the class action against the banks in relation to their wealth or superannuation subsidiaries or associates. And that, on face value, it seems to have some credibility. I would say no more than that. So this is no different. I think the last 2 decades in mortgage lending in Australia has been an absolute, what could you call it? It's a picnic. It's a pantomime. And it's all care and no responsibility by everybody. And you now find, I see on TV last night, there was a character in Western Sydney who was expecting to get $1.2 million for something, and he's now being told it's worth $650,000. Now, he may think there's no problem there, that he'll just sit around for a while, but if he has to refinance in 2 years' time, he's underwater by hundreds of thousands of dollars.
Sure. Yeah, and that's a very important point, because, of course, the banks have portfolios of loans and they hold the loan-to-value ratio at the time the loan was actually written.
Yes,
but they actually are required periodically to consider whether those the risks on those portfolios have changed, right? And if prices continue to slide down, in some places we've seen prices drop up to 22% over the last year, that suggests that, in fact, the size of those portfolios and the risk in those portfolios are considerably higher than perhaps the banks would like to come clean on. So not only have we got the issues with regard to potential, joint actions and class actions against the banks, but we've also got fundamental questions about the risks in their portfolios. And then, as you touched on earlier on as well, the risks relating to the funding of those portfolios, particularly as interest rates go up overseas. So
that's right.
I think if I were a bank executive, I'd be quite concerned and a little worried. And I think I made a post the other day saying, well, maybe the executives in these banks and other institutions are now going to have to earn their corn, because for the last 20 years it's been so easy, because everybody was on the upside with property and lending more and more and more, and now the world has changed.
Yeah. And in other words, there was no downside and no reverse gear.
Yeah.
But that is the case, and there's going to be conflagration, Martin. It's the only word I can use.
Yeah.
And I think the effect on the Australian economy is going to be very substantial.
Yep.
Very substantial. And remember that most, or at least 40% of these loans are not having any principal repayments. So cash flow gets affected with banks once there's some defaults, as there will be. So I've got no doubt that there will be legal remedies, and I haven't sought to waste my time or money or the interests of other parties that I'm involved with by pursuing this. And you'll know from my tweets that I've said all sorts of inflammatory things, but I have said what you just said before, and that is that no one's come to realise what the true realisable value of these mortgage portfolios are under stress, i.e. they need to be liquidated. And that was, in fact, all that the 2007-08 debacle in the US was about, was illiquidity, lack of liquidity. And that happens when you've got declining values and reductions in availability of credit.
Indeed. So, the processes are running. Do you think
Yes.
it's going to be another a few months, a year or so before
November.
November
It'll start being made public.
Okay.
And then the money's on the table, the risks are taken.
Yes.
If you're a funder of class action litigation, you have to take the view that if you lose, you're going to get a bloody nose. This is entirely different to shareholder class actions, where it's not a lay down misère, but failure of directors to properly disclose material facts to shareholders speaks for itself. It's black or white. It's not a shade of grey. And those cases, as you know, have all been settled pre to any court hearings.
Yes.
This will be different in many aspects, but that's the nature of the beast. And it might well be that the banks have always believed that there's no way that they could be embroiled in any meaningful litigation. I think they might be changing their view given 2 days ago with the Sloper and Gordon action, and tough luck to the banks.
Interesting. Well, Roger, I really appreciate your time and your sharing your perspective with me. And I shall be watching this with great interest, partly because I think you and I share some common views as to what's gone on and therefore the consequences ahead, but also, of course, the consequences for the lenders and indeed borrowers too. So this is, I think, an important thing that you're involved in. And maybe we can check back down the track to see how things are progressing.
Sure thing. Thanks very much, Martin.
Good to talk to you, Roger. If you like what you've seen here today, please like the post and add a comment or question. I read them all. And if you've already subscribed, many thanks. I appreciate your support. And if you've not yet subscribed, please do so by ringing that subscribe bell. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.